Well, with more on how the euro is reacting to the news, we bring in Daragh Maher. He is the deputy head of foreign exchange strategy at Credit Agricole. He's with us on the phone. Daragh, always glad to talk to you. Do you think there's any significance in that we are seeing a bigger reaction in the euro-yen cross versus the euro-dollar cross?
I think there was a lot of, positioning against the euro across the board. I think in terms of the euro-yen angle, I guess there is still a reluctance to sell the dollar too aggressively because of the U.S. growth leadership. So maybe that explains the divergence there. But overall, obviously, the knee-jerk reaction is just to buy the euro pretty extensively across the board.
Daragh, it's Erik Schatzker here. I want to ask you about the durability of this plan. $1 trillion, it sounds like a great deal of money, but it does bring to mind visions of the early 1990s, George Soros waging war and ultimately winning against the Bank of England. Is the EU and can the ECB stem the speculative tide?
I got to admit, I remain a euro bear. I think we're still up for some. We'll be lower by year end, if you like. But you know, it could be a pretty durable short-term reaction. The policymakers, for once, have got ahead of the market, whereas for so long it felt like they were chasing the market. So I think that points to some greater durability than has been the case in the past. But ultimately, you know, euro still faces the same structural concerns, the same fiscal concerns, and growth dynamic that it did, you know, a few days ago. And I think that is going to continue to pressure the euro. So I suspect a lot of people in the market will be looking to sell into this rally, but maybe not necessarily today.
Yeah, Daragh, I mean, you mentioned the fiscal concerns. I mean, some people are already voicing concern about how the euro governments are going to pay for this plan. When does that show up in the market?
Well, I guess the European governments will hope that they never end up having to pay for this plan. You know, the idea is by providing this kind of insurance, this kind of sop to confidence, that ultimately, you know, these governments will be able to fund themselves and will take the necessary steps. So I think they're hoping in a way that by doing this, they don't need to pay out. And I suspect that will be the reality. But yeah, it does pose, if you like, this contingent liability on Eurozone governments. But I guess they feel that's the price worth paying to stabilize the situation.
Thank you very much. Daragh Maher joining us there from London, Deputy Head of Global FX Strategy at Credit Agricole.